So a company receives a 3-year 280,000 zero interest bearing note that has a present value of 16,500. How would you record this journal entry? So first off, they received this note, um, which would be an account receivable at the 20,000, and then even though it's zero interest bearing, there's still implicit interest. So then suppose this is credit revenue, 16,500, and the discount, 3,500. Okay. Credit cash. Number 15. A company receives 7,000 non-interest bearing note for sales inventory. The market rate is at the time of sales 8%. The note is due in full at the end of 3 years. Assuming an annual interest rate of 8% is appropriate. Present value. Okay, so January 1st, a note receivable of 7,000. Well, if it's inventory, let's click revenue. It's a sale, so credit revenue. Years, it's 5.57. And discount on the note receivable. 7,000 minus 5.57. Okay. Company issues a 4,000 4-year zero interest bearing bond for sale of inventory, assuming an annual interest rate of 4% for 4 years, appropriate the present value. So there is a note receivable for the sale of inventory, 4,000. There is a 4% interest rate for 4 years, so the present value or credit revenue at the time of sale is 3,419. So then the discount 3,419, discount 501. A company sold goods in exchange for 5,000 2-year zero interest bearing note. The note is issued to a high-risk customer and the market rate for a note of similar risk 7%. Assuming an annual interest rate of 7% is appropriate, present value of the principal $4,367. So the note receivable 5,000, and the sold for goods, so credit revenue at the current market rate of 4,367, and discount of 630. A company sells 2 lamps to a customer for an open account of 2,000. Each lamp sells for 1,000. Open account most likely means AR. So AR 2,000. sale or credit revenue, maybe credit revenue. So 2000. So the return of the lamp, I would say it's most likely sales returns. Well, the AR first would have 1,000. We return it back to AR, and then sales returns have 1,000. Debit sales and returns, and then credit accounts receivable. Okay, that makes more sense. A company has sales of 12,000 and sales returns allowance of 200. So net sales would be 11,800. Sales return allowance account is a contra revenue account. Journal entry for return of sale of goods is debit sales returns and allowances. So these are return the account receivable turnover. So company A sells goods for 5,000. Company B returns 110 at 45. And company A expects that the discount will be taken. Company A uses the net method of accounting. What amount should the company A record for accounts receivable? So they expect the discount to be taken. So the AR, suppose it'll be 5,000, and the inventory how much? 1% of 5,000, 50. So inventory 4950, and then the discount of $50. Should record for accounts receivable. Oh, okay. So there's like the net method and then the gross method. So how is accounts receivable recorded on 6/30 for a company using net method for a sale of 500 on 6/18, payments made on 6/30 with payment terms 210 at 30? Well, the discount is going to be forfeited. Accounts receivable. So on 6/18, there was a sale of 500 on the accounts receivable using the net method. So I assume you could assume that they thought that the discount was going to be taken. So 2% of 500, 490 for the AR, and then most likely some type of credit sales, credit revenue, of 490 as well as the discount. Credit revenue. Sales account. Payments made on 6/30 with payment terms 2/10. So on 6/30, payments made on 6/30. So the discount's gonna be forfeited. So then they'll receive cash of $490. Well, I mean, most likely total cash $500, and then the AR, which is $490, and the forfeit of discount. So a company made a $25,000 sale on account with the following terms, 115 and 30. How much revenue should be recorded using the net method? On the net method, so they made a $25,000 sale on account. And this AR, the net method, they're going to assume that the discount will be taken. 25,000 times 0.1. 2,500. So the AR will be 24,750. And then the the discount on AR is also debited to 50. And then the credit revenue will be 25,000. Company made a 25,000 sale on an account with the following terms. So using the net method, it's going to be 25,000. Or thinking the net method, is 24,500. Company made 25. Okay, so this one here, like 34, is 25,000. Company sold 23,500 of inventory items on credit with terms 2/10/15 at 30. Full payment are received on August 1st. There's a journal entry to record payment. So July 11th, company sold 23,500 using gross, so 23,500 AR, 23,500, and then so the credit revenue, 23,500, and then on August 1st, full payment was received. So then they received a full payment, so they will receive a discount as well. So they will receive 23,500 times 0.2. cash 23030 and discount 470 and the AR 2370. Cash discount. Okay. A business realizes that collections from a customer is impossible, so the accountant needs to write off the uncollectible amount using the allowance method. What journal entry is used for this purpose? So a write-off of the uncollectible amount. So let's say like you're trying to write off $1,000. So like what would happen is, first off, like if, for example, it's from AR, so they would deduct 1,000 from the AR. The allowance for doubtful accounts. Okay, 1,000 from there. From the allowance of doubtful accounts, the AR, and then the AR will go down. And then because it's a write-off, well, if that's a write-off, allowance for doubtful accounts. Well, actually, it wouldn't come out of AR. It would actually come out of bad debt expense. So 26, 36. Oh, okay. Actually, no, you're right. It's from AR. $37. The December 31st, 2019 trial balance for company reported a $100,000 debit balance in accounts receivable. Management estimates some percent of that receivable will not be collected. Prior to the year-end adjustment, there was a $1,000 credit balance in the allowance for doubtful accounts. What net realizable value of account AR will be reported? So this is a tough one, but pretty much the prior adjustment of $1,000 credit balance in the allowance for doubtful accounts isn't used in this calculation. So then actually it'll just be that 10% of the AR that's not going to be collected. So the net realized value of the AR account would be 90,000. Company used the allowance method for uncollectible accounts. November 10th, the company wrote off a customer's 4,000 account receivable. So November 10th, they wrote off the customer's 4,000 account receivable. So a write-off of that, first off, it would come out of the AR. So the AR would go down 4,000, and the allowance for doubtful accounts, 4,000. But then December 1st, they actually received that payment. So like they would receive that most likely in cash. So they receive that in cash, and then it would go back to AR. What's the allowance for doubtful accounts? Actually, it's not allowance for doubtful accounts. It's actually bad debt expense. So then AR would actually go up. So like the AR would go up 4,000, and the I'm thinking the allowance for doubtful accounts would go down 38. So the AR, so AR 4,000. Yeah. Credit allowance for doubtful accounts. Oh, and then they would receive cash of 4,000, and then the AR will go down. A company has unadjusted credit balance in the allowance for doubtful accounts 10,000. The following aging schedules. What is the journal entry for accounting bad debt expense? So there's an unadjusted credit balance. So they need to record that expense. Um, you would debit the allowance for doubtful accounts and credit the bad debt expense, because debit bad expense, bad debt expense, credit bad debt expense, credit allowance for doubtful accounts.